In 1929, Wall Street was not the financial heart of the world. It was an echo chamber of human arrogance, an inverted pyramid of confidence balanced on a single thread. Everyone expected salvation for the impending crisis to come from the gods of finance. The ultimate paradox, however, was that the heroic attempt at rescue was the very signal that accelerated the catastrophe. On that Black Thursday, the stock exchange became an asylum. Sell orders turned into an avalanche. The small-time investor, the cobbler, the taxi driver who had mortgaged his future on U.S. Steel, watched the ticker machine, waiting for a miracle that never arrived. Their fear was palpable. Exactly at 1:30 p.m., hope arrived in the form of the respected Richard Whitney. Representing the nation's most powerful magnates, he walked onto the trading floor and made an aggressive bid. He bought a massive block of shares well above market price, a theatrical move designed to restore faith. But the crowd didn't see a savior. They saw thinly veiled panic, a desperate final gasp. That show of strength, rather than calming the masses, ensured the total collapse in the days that followed. We think we know what triggered the Great Depression, but the real lesson is, why were the men who tried to save the market actually the ones who guaranteed that the very next day investors jumped off buildings in New York? In 1929, Wall Street was not the financial heart of the world. It was an echo chamber of human arrogance, an inverted pyramid of confidence balanced on a single thread. Everyone expected salvation for the impending crisis to come from the gods of finance. The ultimate paradox, however, was that the heroic attempt at rescue was the very signal that accelerated the catastrophe. On that Black Thursday, the stock exchange became an asylum. Sell orders turned into an avalanche. The small-time investor, the cobbler, the taxi driver who had mortgaged his future on U.S. Steel, watched the ticker machine, waiting for a miracle that never arrived. Their fear was palpable. Exactly at 1:30 p.m., hope arrived in the form of the respected Richard Whitney. Representing the nation's most powerful magnates, he walked onto the trading floor and made an aggressive bid. He bought a massive block of shares well above market price, a theatrical move designed to restore faith. But the crowd didn't see a savior. They saw thinly veiled panic, a desperate final gasp. That show of strength, rather than calming the masses, ensured the total collapse in the days that followed. We think we know what triggered the Great Depression, but the real lesson is, why were the men who tried to save the market actually the ones who guaranteed that the very next day investors jumped off buildings in New York? That Tuesday, however, did not emerge from a void. It was the intoxicating culmination of an entire decade spent dancing carelessly on the cliff edge. The 1920s, the Roaring Twenties, had redefined ambition. Prosperity was not a goal. It was an innate American right, fueled by cheap credit and boundless faith in technology and finance. The stock market was the new American religion, and Wall Street its gilded altar. In this new era, it was said that the business cycle was dead. Stocks would rise forever. This intoxicating belief was shared by everyone, from the titans in mahogany offices to the shoeshine boys on the street corner. The small investor, lured by the promise of easy riches, had borrowed heavily, buying on margin, to stake a claim in what they believed was an irreversible upward trajectory. At the forefront of this unchecked confidence stood figures like Charles E. Mitchell, the flamboyant head of National City Bank, dubbed the financial Jupiter. Mitchell assured the public, even as the speculative bubble swelled dangerously thin, that the market was fundamentally sound. He was the high priest of this cult of confidence, and his words were gospel. Every broker and banker felt invincible. Every small success only fed the certainty that they were geniuses, destined for endless wealth. They weren't just participating in capitalism, they were owning the future. But the structure of this wealth was hollow. The higher the prices climbed, the less grounding they had in reality, built instead on pure, unadulterated hope and borrowed money. In the late summer of 1929, the air began to thin. Interest rates rose, and whispers of unsustainable debt crept through the financial district. Yet these were swiftly dismissed as the nervous murmurings of the overly cautious. Then came the chill. On Thursday, October 24th, dubbed Black Thursday, the whispers turned into a roar. For the first time, panic surpassed confidence. Millions of shares were dumped onto the trading floor. The ticker tape ran hours behind, creating a terrifying vacuum of information as prices plummeted into oblivion. That day, the euphoria of a decade instantly crystallized into terror. It was then that the old guard made its desperate, symbolic stand. Richard Whitney, the stately floor broker representing J.P. Morgan, stepped forward. At precisely 1:30 p.m., Whitney walked across the floor and placed an astonishing public order. He purchased a massive block of U.S. steel stock far above the current market rate. The action was intended to signal reassurance. The powerful institutions were intervening, control was being restored. For a brief, dizzying moment, it worked. The plunge halted. The market stabilized. The weekend offered a desperate, false truce. But Whitney's performance, magnificent as it was, achieved the opposite of its intention. It confirmed that the panic was so severe that only an emergency maneuver by the largest bankers could stop it. The 2-day reprieve wasn't a cure, it was the terrifying dead calm before the tidal wave hit. The small investor, who had seen their paper fortune slashed in half, spent those 2 nights staring into the chasm, wrestling with an existential choice. Risk everything they had left on a turnaround, or admit total defeat. When Monday arrived, the selling resumed with renewed vigor. And then, on Tuesday, October 29th, the market stopped collapsing and simply broke. It was in those days following the definitive ruin that the true psychological horror unfolded. The catastrophe was not merely financial, it was the annihilation of identity. The man who had believed himself a master of the universe, the architect of his own success, suddenly realized he was nothing more than collateral damage, left with a worthless ledger and a destroyed self-image. The shame was absolute, piercing the soul deeper than any debt. For those whose entire worth was tied to the height of the market and the belief in the infinite American ascent, there was only one permanent exit. The rumor that had haunted Wall Street's giddy years, the suggestion that men would prefer death to disgrace, was about to become the defining, horrific visual legacy of the crash. But before the final, desperate leap, the stage was set for an even more terrifying descent. The market itself was falling faster than any human body ever could. When the New York Stock Exchange opened on Thursday, October 24th, 1929, the selling was immediate and crushing. It was not an orderly liquidation. It was a stampede toward the exits, a terrifying flight from phantom losses that were quickly becoming devastating reality. The volume was unprecedented, a flood overwhelming the capacity of the financial system. The ticker tape, that vital pulse of the financial world, began to lag hopelessly behind reality, sometimes by over an hour. Investors calling their brokers to inquire about a stock ES price were given numbers that were ancient history. The actual value was always lower, often catastrophically so. This disconnect between information and action amplified the fear, creating blind panic where rational assessment once stood. By 11 a.m., the floor of the exchange was a physical maelstrom. It was no longer a market of deliberation, but a screaming pit of chaos. Brokers, their faces pale and slick with sweat, struggled to hear frantic margin calls being relayed from their offices, orders demanding immediate cash to cover falling shares. Small investors, many of whom had borrowed 90% of their investment capital, watched their dreams dissolve into debt within minutes. Shares of blue-chip companies, General Electric, Radio Corporation of America, RCA, and Westinghouse, became worthless scraps of paper almost instantly. The wealth of an entire generation, fueled by the speculative excesses of the Roaring Twenties, was evaporating faster than morning mist. It was in this desperate atmosphere that the dreadful rumors took hold, the ones that would define the era. Tales circulated wildly, whispers of men leaping from windows high above the canyon of Wall Street, from the top floors of the Equitable Building, from the offices overlooking the frantic streets. Whether statistically true or exaggerated by the fever pitch of the moment, the psychological truth was undeniable. The financial collapse felt like a literal, physical death. The suggestion of investors choosing the pavement over poverty cemented the horrifying legacy of that day. The fear was infectious, spreading from the financial district into the rest of the country, crippling confidence in the very stability of the American promise. The Roaring Twenties had stopped roaring and had started screaming. As the noon hour approached and the market approached total paralysis, the titans of finance realized they could not stand idly by. The fate of American capitalism rested not just on their personal portfolios, but on their collective nerve. They gathered discreetly at 23 Wall Street, the iconic House of Morgan. This cabal included Charles E. Mitchell of National City Bank, Albert H. Wiggin of Chase National, and other colossal figures who, only hours before, had assured the public that the economy's foundations were sound. Now they pooled immense private resources, tens of millions of dollars, betting their personal fortunes and, more importantly, their reputation on one desperate act of faith. They would intervene to stem the tide. The plan required a hero, or at least a visible symbol of immense authority. They chose Richard Whitney, Vice President of the Exchange and the Morgan representative. Whitney, known for his patrician demeanor, strode onto the chaotic trading floor, a beacon of measured calm amidst the frenzy. He walked deliberately to the post where U.S. Steel traded, paused dramatically, and without flinching, put in a monumental order. He bid $205 per share, significantly above the current asking price, for 25,000 shares. This was a statement, not a trade. Then, Whitney moved methodically from post to post, placing similar massive bids for other core stocks. A profound hush fell over the floor. The gesture was instantaneous and unmistakable. The big money was backing the market. The crisis was being managed by the greatest minds in American finance. The crowd erupted in a spontaneous cheer, a unified cry of relief, hope momentarily blinding them to the underlying disaster. For a glorious, desperate afternoon, the strategy seemed to hold. The market closed, having traded a record 12.9 million shares, but the bleeding had been stemmed. The worst, it seemed, was over. The newspapers, desperate for good news, declared the crisis averted. The bankers had saved the day. But the intervention was a mirage, a powerful theatrical performance that only delayed the inevitable. The small investor, crushed by margin calls and terrified by this massive display of centralized, desperate power, used the brief reprieve not to buy, but to quietly liquidate whatever meager holdings remained. They understood the terrifying subtext. If the giants of finance had to step in so dramatically, it meant the bottom had truly fallen out. The temporary stabilization was merely a deep, shuddering breath before the final, fatal plunge. The weekend offered no rest, only dread, preparing the world for the terrifying realization that October 24th was not the climax of the tragedy, but merely the gruesome prologue to the utter obliteration that awaited them next week. The promise of calm delivered by the powerful banking syndicate, championed by Richard Whitney's defiant bids, lasted exactly one weekend. It was a brief, manufactured inhalation of relief before the lungs of the American economy deflated entirely. The fragile belief that the right kind of people could staunch the bleeding evaporated over those 72 hours, revealing the deep structural rot beneath the roaring facade of the 1920s. When the market reopened on Monday, October 28th, confidence was an utterly depleted commodity. Fear had solidified, hardening into pure, unadulterated hysteria. Sell orders flooded in so rapidly, a deluge of panic selling, that the antiquated ticker tape machines on Wall Street could barely keep pace, trailing the market reality by hours. What little stability Charles E. Mitchell and his allies had engineered quickly dissolved, making the official rescue attempt look less like heroism and more like a desperate feudal gesture, a momentary dam against an oceanic tide. This proved to be the ultimate plot twist. The highly publicized intervention, intended to restore faith, instead signaled the sheer, terrifying depth of the peril, validating the suspicions of the small, terrified investors. They didn't need an analyst to tell them. They knew the Titans were scared, and if the Titans were scared, the end must be near. Black Monday saw a monumental drop, unprecedented in scale. The following day, October 29th, 1929, Black Tuesday, delivered the final, fatal blow. Over 16 million shares changed hands, many sold at any price the desperate sellers could achieve. The wealth of an entire generation vanished in the span of 4 trading hours. The vision America held of itself, of perpetual progress, guaranteed prosperity, and boundless wealth, collapsed with the same violent speed as the stock prices. For those who had leveraged everything, who had mortgaged their homes, their futures, and their dignity on worthless paper, the end was not merely financial, it was existential. This is where the grim, legendary climax of the era unfolded. giving rise to the image that would forever haunt American memory. The man in the suit and fedora, leaping onto the cold pavement below. The urban myth of investors jumping from skyscrapers was born not necessarily from verifiable data, proving a mass epidemic of suicide on that specific day, perhaps, because the immediate tragedy was too pervasive to be confined to a single statistical method, but from the profound psychological reality of the fall. Many did fall. They fell from high social pedestals, they fell into abject poverty, and yes, some, driven past the point of endurance by the absolute annihilation of their future, fell from the very skyscrapers that symbolized the era's arrogant, unbridled ambition. The crash was the traumatic inception of the Great Depression. The fall did not stop on Tuesday. It continued relentlessly throughout the entire ensuing decade. The lasting lesson of 1929 is not just about regulation or financial mechanisms. It is that when the promise of easy wealth overshadows fundamental responsibility, the reckoning is measured not merely in lost dollars, but in shattered lives and decades of pervasive suffering. The day that changed everything was not the day the market simply broke, but the day America finally woke up and realized that the shiny, frictionless ladder to prosperity they had been climbing was, in fact, a disguised precipice. That day did not end when the Wall Street bell rang at 3 o'clock. Ruin now had an address and a name. The American promise of infinite wealth collapsed in a single week, and with it, the confidence of millions. While official statistics record few literal fatalities from jumps off buildings that fateful day, the myth, the day investors jumped off buildings in New York, was far more important than the fact. It was a dark metaphor for the suicide of hope, the psychological price paid by those who saw their life savings turn to dust. The rescue orchestrated by the great bankers, though dramatic, proved utterly futile. They managed to stop the bleeding for a moment, but they could not save collective faith from the abyss. What remained was the Great Depression, a decade of widespread misery forged by financial arrogance and a stunning lack of regulation. Black Thursday taught the world that unchecked greed not only blinds, but ultimately devours its own children. It was the moment the celebrated roar of the 20s transformed into the helpless groan of a shattered nation, proving that the greatest risk is not the market falling, but humanity forgetting its own profound fragility.